Okay, guys. Well, thanks so much for making your way to this webinar today. My name is Juan Colon. I'm the CEO with tradeslive.com, the company I co-founded with my brother and former currency trade leader. And actually, it's a great time to speak to you all today because we're also launching a new proposition next week. More on that later, called violating.com. So about my background, I spent the last 15 years in capital markets engaging in the distribution of complex financial products, things like interest rates or FX and equity derivatives. I have a background in risk management. Whenever I distribute the slides to this, I will put in my LinkedIn profile for you guys to reach out as you see fit. More relevant to today's topic, I have been the privileged person to take over the application process for tradeslive's FCA application to become an asset manager to get our managing investments permission. And more recently, we have also obtained permission to operate our mass principal broker. Now, very importantly, what I'll tell you today is with a view on practical applications and how to get to manage capital legally, but I'm not a lawyer, and you should not take any of what I say today as legal advice. So please, you have been warned of that. Now, I'm very happy to take questions as we go along on any of the topics that we cover. If I think, given that I know what's coming later, that they are relevant to be answered then, I will do so. If not, I have reserved some time for Q&As at the end of this webinar, which should hopefully run for about half an hour in terms of me going through the presentation, and then as much as you guys want to go through your questions. And if you have any more detailed questions that I cannot answer online, I'm very happy to take them offline, down the line. So, first of all, before we kick off, just to give this a bit of more background, it's like, what is the point of managing investor capital? Well, the way we look at this is, I call investor capital your healthy leverage. Now, if you look at this, you can see your life expenses, which is this huge weight on the left-hand side. You have your savings, which is this tiny little green dot on your leverage. And in addition to that, you have some investable trading skills. And the best way to make the most of those skills is not just to trade your own capital, but actually to convince investors to trust you with their own invested capital, which is the kind of healthy leverage I mentioned before. Now, when it comes to sources of possible capital, we always think of two possible sources. There's the more kind of friends and family, what I called retail here, with its pros and cons, and institutional money, which again carries its pros and cons. So let's go through them one step at a time. Now, in terms of your retail money, obviously, nothing is more accessible than your friends and family. To some extent, you're going to know more about trading than they do. So in some cases, well, you can convince them in different ways. And as we know, there are all too many sites out there where you can fool some of the people all of the time, and you can make a benefit of that. The business model for that is to get money on the commissions from the investors that follow you. And to that extent, that conflicts with a business model about making money, participating in the success you make for your customers. Obviously, that has, as I already hinted, some cons. People who don't really know about trading, they're not going to trust you as much as someone who understands that the markets go up and down. And they're also going to be impatient because they expect their money now and fast. So you could also find yourself losing investors as you hit one of those losing streaks, which all traders have. The bigger issue is also that this is a hard-to-scale business model. It's really hard to trade and market to investors at once. So most people are either good traders but bad marketers, or the other way around. But it's really, really hard to keep your eyes on two separate goals at the same time. And the other issue is that if you want to do this legally, there are legal and operational overheads that, as we'll discuss later. So when we go to the institutional side of things, obviously you're looking at the legal side of things because an institutional investor knows what he's doing, and he'll make sure that you get legal coverage to manage his money. He's more rational, therefore less impatient. You hit onto scalable business models. As you know, there are hedge funds out there that manage billions of assets under management. and you can make a very good money on revenues for performance if you are a good trader. On the downside, it's actually quite hard if you don't come from the institutional side of the industry to build a reputation for yourself. So it takes time until you prove that your results are actually really worth it. And it'll take effort as well, because these people will check you for fraud, that you haven't forged your track record. And we'll also want to make sure that you're not just like a one-trick pony that who got lucky for some time and then basically run out of luck. The issue with institutional investors is to always watch out for your intellectual property, because quite often this demanding due diligence that goes on is also a way for them to reverse engineer your strategy, and that actually is bad news, because the last thing you want is for these people to basically understand what the trick is, take it away from you, and never pay you for it. So with that in mind, today's title is really legally managing investor capital in Europe. So let's get on to the regulatory mechanics here. So I'm not going to go crazy about the legal side of this, but it's important to explain how things, who does what in this regulatory setup. Now, also I should mention that what I'll say today is not black or white. Some of the issues have been great for quite some time, even though in some jurisdictions, as for instance by the FCA in the UK, there has come some clarity as recently as last month. So how this works is there's a European regulator called ESMA. They basically issue the law, which is the general regulatory framework is MiFID, called short for Market in Financial Instruments Directive. And this law that ESMA issues is then enforced by the national home regulators of the participants in the market. So they issue that each national regulator issues the national translation implementing MiFID for their own regulatory jurisdiction. In plain talk, the FCA drafts the law according to the ESMA guidance. They have some scope for national discretion, so they can go further than ESMA if they wish to. They can make things even more demanding than ESMA. And they're also the enforcing agent that fine and prosecute people who break the law, in this case. Now, MiFID is a standardized way of regulating across the European Union. The whole idea is that you get regulated with one home regulator, for instance, the UK, and then you get a passport that allows you to operate legally in the rest of the European Union, so all the 27 member states. So, on this note, how does the regulation work? Well, basically, if you're going to be regulated, you can only perform regulated activities by agreeing to be regulated, asking for the permission before carrying out that activity, and complying with the requirements that the regulator demands from you. And basically, MiFID works alongside three separate questions. The first question is, what instrument do you want to legally manage for your investors? Now, we'll get to the list of instruments in a second, but generally the guideline is, if you're doing something which is high risk, for instance, carrying high leverage or with over-the-counter products, then they're going to look at you much more closely than if you do something with less risk. The next point is what regulated activity you're going to carry out. As we'll see in a second, there are two activities that come into question today. One is advising on investments, which could come into question for things like manual copy, the ones you see in some sites, or for trade signals, when you're providing trade signals to people who choose to then execute them. And the other activity for which you also might require permission is managing investments, and that's the sort of setup that you have in a PAM account, as we know them, within a broker, or mirror trading, which is the setup when you have broker and followers, trade leader and followers in different brokers. And last but not least, most importantly, it's the question of who purchases the service. If we're talking about retail, i.e. inexperienced investors who may not know what this instrument is that they are asking you to manage for them and what sort of setup they are in, that's where you have the highest regulatory burden. Or you can have less and less other models where you're actually dealing with an elected counterparty, so people who know what they're doing, in which case you can opt to take some shortcuts. It's less demanding in that case. But it's very important to note that unless you can prove that the counterparty you're dealing with meets the criteria to be an elected counterparty, by default, anyone is going to be a retail investor. So you have to meet the most demanding criteria by default. Now, as of today, so 29th of April 2014, this is the standard regulation today. Obviously, this can change. Now, the UK is no longer a grey zone, so up to now, it wasn't entirely clear whether managing a PAM account or being a trade leader on a mirror trading service actually required you to hold managing investments permission. But now this is no longer a grey zone. You do need to hold that permission. Otherwise, in the UK and a few other jurisdictions, you might be engaging in illegal activity by carrying out a regulated permission without having the permission to do so. So let's go briefly through the list of instruments. On the left-hand side, we have the publicly quoted instruments, is basically equities or debt by different issuers. And you also have over-the-counter instruments, which they call contractually based investments. And the ones that are probably most relevant to the listeners in this call are futures, for stocks, indices, and so on, and commodities, contracts for differences on stocks and indices, spread bets, and rolling spot forex, which is the regulatory name for what we all know as forex trading. So that's basically one of the questions that they'll be asking you: what instruments are you trading? This is what you will have to fill in your application form. Incidentally, these are taken straight from the FCA's application form. And just to be clear, the sort of questions that I'll be talking about today are the very specific forex-related setups. The first one being PAM, automated replication, whereby an investor chooses to replicate whatever it is you do normally on your MP4 account. In that setup, you have a trade leader here on the left-hand side who's executing these trades with broker A. And then you have a bunch of other investor customers who are also customers of broker A for execution, who choose to automatically replicate whatever trade leader is doing. Now, the FCA considers this managing investments, meaning if you don't have the FCA permission to manage investment, you could run into legal trouble by doing this. The next setup is similar to the PAM setup, but in this there's a slight difference in that the trade leader is operating from his own broker, broker A in this case. He's then operating with a provider of signals, as you know, there are sites out there who do this, and you know very well who they are, who then report that to the investor, and this investor then mirror trades or automatically replicates what the trade leader just did. And again, the FCA has recently issued guidance, to which I'll be happy to send you links at the end of the webinar, that this is actually an activity of managing investments. And last but not least is the same setup as with the mirror trading within a broker or across two different brokers, in which again a trade leader takes a trade, he then publishes which trade he just did, reports that to some signal provider and so on, and then an investor on a case-by-case basis, not automatically in this case, chooses not to replicate that trade. And in this setup, obviously, you're not managing investments because the investor has discretion to choose to replicate your trade or not. But the FCA considers this investment advice, because it could be conceived as if you were telling the followers that you have, okay, now you should trade the euro-dollar, and that is considered an investment advice. So these are the setups about which we'll be talking, and I'm just going to go through what regulated activities you need a permission for in this particular case. And this is basically the range of regulatory activities that the FCA considers from left to right. Apologies for formatting. Now, obviously, if we start from the left-hand side, you have advising, excluding pension and transfers of opt-outs. This is the sort of permission required under the new regulation to be providing a lead trade in a copy trading service, and by copy trading without mirror trading in this case. Then, obviously, some people choose to introduce their own investors to their broker, in which case they're acting as introducing brokers, for which you need a permission to arrange or bring about deals and investments. And the last three activities are the ones that we actually mean by legally managing invested capital. The first one being dealing in investment as an agent for your customers, so you will be dealing with their money. To manage their investments, that's the other permission. And then obviously, because presumably you don't want to set up a broker to do this. You would have to arrange for someone, presumably a broker, to safeguard and manage your customers' assets as you trade them. In other words, the customer monies would have to be put with a broker, and you would be in a position to choose who that broker would be. And this is the setup that applies to euro trading and PAM accounts. Now, what does it actually mean in practice? Well, in practice, you'll have to go through a three-tiered process. The first step being to apply for the permission. Then there are things you will have to do whenever you take on a new customer, a new investor, and the client intake. And then on an ongoing basis, you have to meet certain rules as to how to do things like making sure that your customers know what they're doing, providing them disclosure as to what the P&L has been in the recent month, and so on and so forth. So starting with the application side of it, the first and foremost question that you'll have to convince the FCA that you are a fit and proper person to carry out the activity for which you are applying. So you can check out the links on the FCA site to see the forms that they demand that you answer. And there are things in there like not having misled an investor in the past, not having engaged in criminal activity, not having done the sort of things that would make people wary about trusting you as a fit and proper person to manage their monies. Now, for the FCA to consider your application, you'll obviously have to fill it in and submit it, for which there are different fees. The fees range from £1,500 for simple applications like Arranger, which is the one that you need to become an introducing broker. In case you want to legally manage investments, the application fee is something like, it's actually exactly at this point, at the point of writing, £5,000. And from the point of you submitting the application and paying the fee for the FCA to look through your application, you can typically expect between, realistically, 6 to 9 months, if not longer, for them to come back with some questions. You have to provide things like financial forecasts and so on. And eventually, if they think you're a fit and proper person and you prove to them that you have the technology in place to be carrying out business, then you'll receive the application to become what they call a BPRU 50K firm. So a BPRU 50K firm is nothing else than shorthand for the capital you have to put down, shareholder capital paid in, to guarantee to the FCA that if something actually bad happens to the monies you're managing, in that situation you'll have put in 50,000 euros of your own money in escrow to meet whatever legal liabilities you might have at that point. Now, this is notwithstanding the fact that if you do something wrong, obviously they'll keep your money, but they can also prosecute you in different ways. We'll come back to that, but essentially what the FCA does is they issue a warning if you're not doing what you should be doing, initially privately, so they only tell you. If it goes further than that, then they issue that warning publicly to tell people something like, well, maybe you should stay away from this person because they're not someone that is complying with the regulatory duties. And if it goes bad enough, in addition to paying penalties, they can basically withdraw your license. So when it comes to the client intake, which is basically allowing customers to open an account with you for managing, there are certain requirements that the Retail Distribution Review, shorthand for RDR, puts on your staff. So they'll have to hold statements of professional standing, shorthand for SPS, and for you to achieve that, there are some exams that must be passed, which essentially teach you how FCA regulation works. This is mostly what I'm explaining you today at a bigger level of detail. Making sure that you learn to identify and manage any conflicts of interest, that, as we'll come back to in a second, to make sure that you always make the best choice for your invested customers, and really that sort of setup. The exams themselves, they're not very, very hard, but they do take time, and they also cost about £500 per person to actually pass. So a question from everyone, which is relevant to everyone else: what are these £5,000 fee? Well, the £5,000 fee is the fee that the Financial Conduct Authority demands from the applicants to review the application. It's a way to basically pay for them to looking at your application. So that answers the question. It's basically without paying the £5,000, they will not look at it. It's the legal fee that the FCA demands. Okay, so we were here with the suitability assessment. So the suitability assessment, yes, so this is the question I get from one of the participants, which I think is relevant. This is in the EU. Well, this is for sure in by the FCA, so the Financial Conduct Authority in the UK. Different regulators have different business models and they charge different fees. This is I'm specifically centering here on the UK model. I know of other jurisdictions that they also charge similar amounts because essentially there's a fair amount of work by the case officer involved in actually reviewing all of the application and making sure that you supply all the information. Okay, so we were here with the suitability assessment. A question was operating outside of the EU but attracting UK customers. That's another interesting question. Thanks for asking. Well, essentially, the regulation that you hold allows you to operate in the jurisdiction for which you hold permissions. So if you're attracting a customer, say, from China using your FCA permission, then you are within the bounds of the law in the UK, but you'd have to check with the local regulation in China to make sure that you're not doing anything which is outside the law in China. In other words, the permission that you hold in the UK allows you to operate in the UK with a passport if you request it for the rest of the European Union, but it doesn't ex ante offer you any guarantee to manage investor capital outside of the European Union. If you want to do that outside the European Union, you would have to seek permission to operate in the jurisdictions from which your customers hail from. So it's really a question of where the customer comes from and whether you have the permission to take on customers from the UK, EU in this case, or other jurisdictions, in which case you probably have to attend another webinar on that. Okay, so on the suitability assessment, basically what happens there, you have to assess whether the investor you're taking on has, on the one hand, the knowledge to understand what it is he is doing. So basically, you need to make sure that he knows that you're trading leveraged investments, that you're trading here with margin, and that there's high risk. There could potentially be high risk involved, so much so that the customer could lose all his money, and he should know that. Otherwise, you're breaching your obligations towards your investors. On the other hand, so the first hand is to know that to make sure that he knows what he's doing. On the other hand, you also have to make sure that the customer can afford to risk the money that he is risking. So, for instance, if somebody tells you that he basically can save 100 euros a month, then it would be hard to accept 5,000 euros from that customer and take up that customer on a high-risk strategy, because he could lose 5,000 euros, which basically means 4 or 5 years of savings for that customer. It's those sort of checks that you have to make sure and document, because the FCA can come at any time and check your records to verify that you're carrying out proper suitability assessment to make sure that you can accept the customers that you are accepting. In addition to that, there are broader obligations such as know your customer, so KYC, and AML, which stands for anti-money laundering, which don't really fall on your shoulders. That those would typically fall on the broker's shoulders that is handling your monies and the execution. But you have to make sure that, for instance, you're not accepting money from terrorist jurisdictions. So if you're not making sure that your broker does those sort of filters, obviously your broker would be in trouble, but then you would also be in trouble as well, because you have a fiduciary duty to make sure that everything is being done fit and proper, which is what the FCA demands from you. Then on an ongoing basis, obviously you have to do this on a one-off, but you have to comply with the procedures to be able to prove at any point in time that you're carrying out the regulation, the business as per the FCA regulations. The things that you have to report in that situation are: what is your P&L to make sure that you still meet your minimum capital requirements, as stated above, the 50,000 euros. You have to report how many customers you have taken on. The FCA will look at things like how many customers you take on for every compliance officer that you have, to make sure that he has enough time to review every application on a case-by-case basis. It's really mostly it's common sense and it's not really hard, but if you add up all that comes into it, well, you know, it ends up taking quite a lot of time that you could conceivably be deploying to studying setup in the market, which then has to go into this sort of activities. And last but not least, for the FCA to accept the application, you have to prove that you have competent staff to carry out the regulated functions that someone holding the managing investments permission has to have. In this particular case, it's a compliance function called CF10, as they call it, control function 10, and control function 30, which is the customer representative that is hand-holding the customer, so to say, in decision making. So at this point, does anyone have any questions that are related to this kind of strictly bureaucratic element of it? Okay, so wait a bit more. There we go. It doesn't seem like there's any more questions. So obviously, the big question that I was expecting is what happens if you don't do this? Unfortunately, that's something that a lot of people do. They don't do this legally. In that case, obviously, there's well, it's like with any other crime. So that you have the possibility of getting away with it with a benefit, or there's also the possibility of getting caught, in which case you kind of end up paying the bill. So in that situation, if you're engaging, for instance, in the managing a PAM account and you're managing investors' money, then the fact that you don't carry the permission does not mean that the investor who has chosen to replicate your trading doesn't enjoy MiFID retail investor rights. So it's out of the question that he doesn't enjoy protection. In that situation, he could conceivably sue you and basically, you know, go after your money. That's the first thing. So you could expect the investor to be in a position to sue you. Which means if you're trading with a broker that is regulated in the European Union, he should take good care to make sure before he allows you to manage a PAM account that you actually hold managing investments permission. If you don't, and they don't say anything, that's probably because your broker is not regulated in the European Union, and that, you know, that's another whole game. You probably don't even want to trust that sort of broker. So that's a personal decision for everyone to be making, but that's the sort of trade-off you're placing there. And then last but not least, you could be sued by investors, but not just your investors, i.e. your friends or people you trust. It could also be investors that you know, are elsewhere with other brokers who have sued your broker and they go after you. So it's, you know, it's not a sustainable business model because you always have a huge legal bill outstanding that could always come back to haunt you. In terms of practical penalties that they actually can impose on you, the first thing they can do is they can put you on a register where individuals have committed offenses, and that would de facto actually ban you from working in financial services for a regulated business for quite some time, if not forever. And then beyond that, if you've committed a serious enough offense, such as running away with customers' money and so on, then they can also prosecute you in court over and above the fact that you didn't have the permission, which is pretty much common sense. You know, that would make you a thief. Okay, now we've gone through the legal regulation. I think what's important to not lose sight of is the alignment check of what you have to bear in mind when you're taking on investor money. So, and that's actually because there's a three-way constellation taking place here. On the one hand, there's you on the left-hand side. You obviously want legal revenues for your intellectual property, and you also want to make sure that you're making the most for that intellectual property. And then on the other hand, you have to try to marry your interests with the broker's interests, who wants revenue. And basically, he wants to attract investors because investors who trade replicating your trades then presumably mean more long-term volumes and business. And for that, he will reward you, presumably, for introducing broker fees. In other words, if you bring in X volume of business from customers and they do 1 yard a month, then most brokers have a tariff whereby you get rewarded on the volume that the customers have done. On the other hand, you also have the investors who come into this because they want to make money, obviously. They want to make money without playing the lottery, so they want non-random systematic returns, which is basically another way of saying they want trade leaders who make money without luck. Because if they make money without luck, then that's another one. That's not a long-term money-making proposition. Now, the investors will pay execution fees to the broker, and actually part of those execution fees are what comes back to you via the IEB. So it's basically the investor pays the broker, then the broker makes money on fees, and then he kicks back some of those fees on IEBs. And here's the biggest conflict of interest, really. That's because the investor presumably will prefer to pay you for success in this case. So if I'm an investor and I'm making 40% per year, year in, year out, I have no problem paying 20% of that 40% to the trader that makes it happen. The issue, however, is that if the broker is charging a ton for execution, like charging a big spread or engaging in negative slippage and so on and so forth, then the investor's money is going to the broker, and but the investor is losing money. Therefore, this is not sustainable. That long term, if the investors don't make money, then everyone loses out. So really, this is the kind of conflict of interest that quite frankly, we think plagues most of the industry, and that we should all bear in mind before even considering going into managing investor capital. So there are some moral dilemmas which we can show here. For the broker, from the broker's standpoint, as you see at the top, both the trader and the investor are his customers. So if the broker sees that your trading is not really better than random, or that the strategy has stopped working, and let's face it, some strategies do stop working, at least for a time, they have a choice to make. So like, do they tell the investor that this strategy doesn't seem to be working too well? In that case, risk annoying the trader that brought the investor in the first place, for whom who's actually one of his IDs or one of his revenue sources. Or they can also choose to basically take sides with the trader and not tell the investor. And if the investor obviously loses the money, then the broker will lose the money for business for good. So that's the kind of the issue on the broker side of things. Then on the trader side of things, the question, and this is really the question for you, if you want to legally manage investor monies, this is the big question for you to ask to yourself. So, are you really someone who's good at trading that's been forced into selling? Or are you someone who's good at selling that actually kind of trades on the side to justify those sales? And depending on one or the other, you choose different combinations of revenue model. The first revenue model is acting as an introducing broker, whereby the higher your rebates in commissions, obviously the less money you're making for your investors. And on the other hand, if you think you can make a good success long term, then you probably want to participate in the full upside from the investor. And in that situation, if the broker is charging the investor a lot of money, then that is eating into the investor profit and therefore indirectly into your profit. And that's really the kind of trade-off that has to be made there. The other issue, of course, is the protection of your intellectual property. And this is a key one that we at Darwinics feel is another critical area. So the question is, can the investors replicate whatever it is what I am doing without paying me for it? And this we know very well from other mirror trading sites, where what happens if you're a good trader, quite often is that people replicate what you do with 0.01 lots, because those are the lots on which they pay your broker and pay you for it. And then they're free to take that intellectual property. For instance, if I know that a good trader has just placed a trade in the euro dollar, I buy that at the cost of paying with 0.01 lots of replication. Now I know that the trader is long the euro dollar. I am free to go to another broker and place 10 lots on the euro dollar without paying the trader anything for it. And that's obviously an issue if you want to make the most for your intellectual property. So hang on, here's a question. Right. So this is a kind of a very good question. I'll read out to everyone. So, considering we provide services to retail audience via a retail broker, how can you prevent situations the broker will not bypass your operation by copying your successful trade? Now, that's the kind of great question that forced us to become a broker ourselves. I'll get back into that in a second, but I'm very happy that you posted that question, because that is the make or break question here. In other words, brokers that are operating a dealing desk, in other words, are trying to obtain returns on their shareholder capital by dealing on behalf of those shareholders, they have capital, and they can choose to deploy that capital against bad traders, as we know it, the kind of dealing desk model. That's not something that need concern a good trader, but what does need concern a good trader is what happens if I am managing, say, as a good trader, a strategy with my 10,000 euros. My strategy can hold 40 million in assets under management by investors, and my broker who has capital knows that. And then how do you know that the broker is not front-running your strategy and basically using up your strategy, killing it without you getting paid for it? That's a really, really good question, and I'll try to answer that in a second because we've thought long and hard about this, and I'll explain how we try to overcome that issue. Although ultimately, there's an element of trust that you cannot avoid. So that was the question on the trader side of things. Very good question. Thanks for that, Jill. Then on the investor side of things, well, how does the investor know that execution is fair, particularly when retail investors who are not used to trading, they're not in front of their computers, they're not seeing exactly what the spread is, they can't check slippage, they can't check the market price against some competing broker and so on. So how do you make sure, as someone who has invited that investor to that broker, that you're not failing that customer's trust? That's a big question. Ultimately, I guess your obligation as an FCA-regulated investment manager is to make sure that you pick a reliable execution venue that is going to provide best execution for your customers. The other one is, from the investor standpoint, is how does the investor, who presumably is also not an expert trader, know if the trader he's following is just a lucky guy who made money for 6 months, but it was just luck, or whether he's actually a good trader who is going to make money on a systematic basis, or at the very least not lose money without by imploding overnight. And then obviously from the investor standpoint, they also want to see how they pay the lease for the intellectual property. So you can make sure that if you have a very good smart investor who knows that you're a good trader and you're letting him know that you just traded the euro-dollar, then you put yourself in a pretty vulnerable position, because then it's a question of trust that he's going to pay you for the full amount that he's benefiting from you, as opposed to doing the 0.01 replication. So ultimately, it's very important that you try to protect your intellectual property, both in the due diligence process, as we mentioned before. So you should give away enough that people trust that you know what you're doing, but you always have to stop short of giving away too much, such that people can basically run your intellectual property and basically not pay you for it. So these are questions that have taken up the better part of 2 years from my point of view. So I just try to explain what our take is to allow traders who are committed to a sustainable business model to make a living off their trading skill. So we're launching DarwinX next week. DarwinX is the successor to TradeSat.com. Maybe you know, maybe you don't. And we call it a talent exchange, in which traders contribute their talent or intellectual property by trading with our STP broker. And investors essentially replicate, without being able to access the intellectual property of the traders trades. In other words, we basically have a dual role. We are an FCA-regulated 100% agency broker that provides STP execution for our traders and our investors. And we are an FCA-regulated asset manager, which basically we've gone through the full package of applications that I've described earlier. And as such, we want our investors to make money. And what we do essentially is offer a trading challenge called Darwinia, where you're just not going to win unless you prove experience, discipline, risk management, timing, and non-random performance. In other words, our rule is to say, if you prove experience, discipline, risk management, timing, and non-random performance, and you make money, the chances that you're just a lucky monkey are very, very, very low. Therefore, we feel confident in offering your skill to investors, which means the traders that trade with our broker, they, in addition to enjoying our execution, they can choose to engage in this competition to work their way up the food chain, the Darwinia food chain, to become electable to investors. And those that make it, what we call investable traders, they come under our own FCA regulatory management umbrella, which in other words means you can sit from home, you trade your money as best as you can, and we'll do our best to get you investors and pay you for it without compromising your intellectual property. And the business model where the investors go live, so we'll start accepting traders from literally next Monday, and we'll offer the platform to the investors in Q3 this year. So there's a question here. So a good question from Joaquin, very good question. So suppose I want to sell an expert advisor, would this be considered as I'm selling signals, advisors or similar? And if this EA has several of its code not in the client's computer but in a server in the internet, so okay, so in that situation, again, if you're selling the execution advisor, the question is, if you are selling the code, you could do that. In that case, you are selling software, and you're not bound by the regulatory permission because all you're doing is selling software, so you don't have to have the permission. But the problem is if you sell the code and the investors know what that code is, then two things happen. Is basically you put all your secrets in that code, and then those people are then free to sell onwards to someone else, de facto actually stealing your intellectual property, which defeats your purpose, I presume. And the other question is if the EA has its code not in the client's computer, basically I presume here you're trying to protect your intellectual property, which I think is a smart move, and putting your server in the internet. So this situation does require you to hold the permission, because in that situation you're actually managing investors' money, even if it's an automated algorithm. The way this would work at DarwinX is that you would essentially trade your own money with your own execution advisor with DarwinX. So you would put your own money on your own execution advisor. We would not know the code of your execution advisor, so there would be no way for us to replicate your strategy. If we thought that your robot or your execution advisor was very good, then we would advertise it to investors as our own product. Then we would charge investors for all the monies that we manage for them, and then we would pay you for it. So in other words, you're sitting from home programming the best EA you can think of. You bring it to Darwinia, the challenge, that you can, by the way, join from any broker. You don't have to be with us to see what our assessment is of your strategy. And if we think it's good, and only if we think it's good, then we will offer it to investors who will then copy it without being able to bypass your intellectual property. So in that sense, it would be the best of all worlds. You sit from home, and your investors enjoy your execution advisor. They don't know the intellectual property, which is another way of saying, I am selling Coca-Cola, but I'm not giving away the formula to my Coca-Cola, which is what you want, and then you get paid for it legally because we give you the regulatory umbrella. Does that answer the question? Okay. By the way, if any of you guys, I appreciate not everyone's mother tongue. So if you have any questions in Spanish, French, German, or Italian, that's something we can do. So the commission. Okay, so the commission rates will charge for traders. We'll charge a commission of $50 per million each way. So that would be $100 per million round trip. So given we'll be using Almax spreads, the typical spread for the euro dollar would be somewhere in the range of 1.2, all costs included. So I hope that answers that question. And this is the setup as I described earlier, just to sum it up rapidly. So on the right-hand side, we have the traders who are trading using our broker. That's a 100% SDP FCA-regulated broker. We are analyzing our customer flow to find the best strategies, and then we offer those to the investors who choose to be customers to our asset manager. And that's pretty much it. So obviously, most importantly, the investor charges us because we are entitled to charge the investor. We hold the manager permission, and then we share the revenues with you. And that's basically one part of it is volume commissions on the total volume done by all of Darwinex, and the other one is a success fee, which goes one-to-one to you as a trader. So if you make 20% profits for your customer, there's a 10% success fee that goes one-to-one. And that's pretty much it. So I don't know if there are any more questions that you'd like me to go through at this point. Alternatively, there's my email that you can email me in the language that I mentioned. I would be very, very happy to answer any questions, both related to us, Darwinex, or to the topic of legally managing investor capital, which is really what we built the company for. So we know it's hard to do this legally, so we've invested into it.